The difference between trading and investing. Welcome, finance enthusiasts! Today we're setting out on a journey to explore a topic that intrigues beginners and experts alike: the difference between trading and investing. Picture this. Trading is a craft that dances to the market's daily rhythms, and investing is a grand strategy unfolding over years. These are two distinct approaches to growing wealth in the financial markets, each with its own set of rules, risks, and rewards. Whether you're looking to dive into the quicksilver waters of daily market movements, or prefer to build a sturdy ship for a long voyage, understanding the difference between trading and investing is your starting point. So let's embark on this journey of discovery and unravel the intricacies of these two formidable financial strategies. Defining trading. Trading refers to the act of buying and selling assets with the primary goal of making quick profits. This could be anything from stocks and bonds to currencies, commodities, or even physical goods. Think of trading as the fast-paced, adrenaline-filled side of the financial world. Some traders, known as day traders, might make multiple trades in a single day, while others may opt for swing trading, where they hold positions for several days or weeks. There's also high-frequency trading, where algorithms are used to make thousands of trades in a matter of seconds. In essence, trading is all about capitalizing on short-term fluctuations in the price of assets. Trading is the high-octane counterpart to investing, where agility meets opportunity in chasing short-term profits through buying and selling assets, be it stocks, currencies, or commodities. Defining investing. On the flip side, investing is more of a marathon. It's a long-term approach where individuals allocate money to assets, such as stocks, bonds, real estate, or startups, expecting them to grow over time. Instead of trying to make a quick buck, investors aim to build wealth slowly, often through a combination of capital gains, dividends, and interest. Investing is about creating a diversified portfolio that can withstand the ups and downs of the market, ultimately leading to financial growth and stability over the years or even decades. Investing is akin to a financial symphony, where money is meticulously allocated across assets like stocks, real estate, or bonds, with an eye on the crescendo of long-term wealth creation. The role of analysis in trading. Let's now talk about the role of analysis in trading. There are two main types of analysis traders use: technical and fundamental. Technical analysis involves studying past market data, primarily price and volume, to forecast future price movements. This analysis can be performed on any security with historical trading data. Charts, patterns, and indicators play a vital role here. On the other hand, fundamental analysis involves evaluating a security's intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. Traders use this information to determine which assets to buy or sell and at what price. Timing is crucial in trading, as profits are often made from exploiting minute price changes. Trading is a duet of technical and fundamental analysis, where charts flirt with financial data, guiding traders in their pursuit of profit in the ever-shifting market tides. The role of analysis in investing. In contrast, investors primarily focus on fundamental analysis. They assess the overall health and potential of a company or asset by examining financial statements, management quality, industry trends, and macroeconomic factors. For instance, when investing in stocks, one might look at a company's earnings, revenue growth, and profit margins. Additionally, investors often consider the economic outlook, interest rates, and geopolitical events. Rather than focusing on short-term price movements, investors are more concerned with the underlying strength and potential of their investments. Investors are like financial detectives, piecing together clues from financial statements, market trends, and economic indicators, solving the mystery of an asset's true long-term value. Risks and returns in trading. Trading can be likened to sailing in rough seas. The waters are choppy and the journey is perilous, but for some, the allure of finding treasure is too great to ignore. Trading usually involves higher risks compared to investing. The prices of securities can be highly volatile on a day-to-day basis. While this can result in significant gains, it can also lead to substantial losses. Leverage, or the use of borrowed funds, is common in trading, which can amplify both profits and losses. Therefore, successful trading requires not just skill, but also an aptitude for risk management. Traders are akin to tightrope walkers, balancing potential windfalls and dramatic pitfalls with every step as they navigate the precarious rope of market volatility. Risks and returns in investing. Investing, on the other hand, is more like planting a garden. It takes time and patience, but with proper care and attention, it can yield bountiful rewards. The risk in investing is generally lower compared to trading, especially when diversification is employed as a strategy. By investing in a broad range of assets, investors can reduce the impact of a decline in any one asset or sector. Furthermore, the effect of market volatility is diminished over the long term, as markets have historically tended to rise over extended periods. In the garden of investing, seeds of capital are sown with care. Through patience and nurturing, they can blossom into a diverse and fruitful portfolio, weathering storms with sturdy roots. Liquidity considerations. Liquidity is another key difference. In trading, assets are frequently bought and sold, making liquidity, or the ability to quickly convert assets into cash, extremely important. Traders need to be able to enter and exit positions with ease. Conversely, investors are less concerned with liquidity as their time horizon is longer. They're more willing to lock up funds and investments that may not be easily tradable in the short term, but have strong potential for growth in the long term. For traders, liquidity is like the oxygen in their financial ecosystem, vital for breathing life into their strategies, whereas investors can afford to hold their breath for the long haul. Psychological aspects. Let's not overlook the psychological aspects. Trading can be stressful and demands the ability to make quick decisions under pressure. It requires constant monitoring of markets and the discipline to stick to strategies even in the face of losses. Investing is psychologically less taxing, as it doesn't require the same level of day-to-day involvement. Investors need patience and the fortitude to not panic during market downturns, staying focused on their long-term goals. The psychology of trading is a thrilling roller coaster, demanding nerves of steel, while the investor's mindset is a tranquil sailboat voyage with an unwavering eye on the distant horizon. Costs and expenses. Costs and expenses are also worth considering. Frequent buying and selling in trading means that traders may incur significant costs from commissions and spreads. In contrast, since investors hold on to assets for longer periods, they usually face lower transaction costs. However, they might incur other expenses, such as management fees or mutual funds or maintenance costs for real estate investments. Trading incurs costs as if sprinting through a revolving door, whereas investing's expenses are more like paying tolls on a long, winding road leading to financial destinations. Choosing between trading and investing. Finally, choosing between trading and investing is not a one-size-fits-all decision. It depends on various factors, including your financial goals, risk tolerance, time horizon, and even your personality. Some individuals may thrive in the fast-paced world of trading, while others may find solace in the slow and steady nature of investing. Making the choice between trading and investing is akin to selecting the right gear for an epic adventure. It depends on the terrain you wish to conquer. Some financial voyagers find their calling in the rapid currents of trading, while others prefer the slow-brewing deep waters of investing. But behold, there are also the versatile seafaring warriors who master the art of both. These individuals deftly utilize a combination of trading and investing, navigating through calm and stormy financial waters alike. Such a dual approach can be particularly effective for those who wish to balance short-term gains with long-term wealth creation, or for those who tailor their strategies according to the stages in their life and evolving financial goals. The time factor. In the race against time, traders are sprinters, dashing across short distances with incredible speed, while investors are long-distance runners pacing themselves for a marathon that spans years or decades. The skill set. Traders are the financial world's sharpshooters, with a keen eye and reflexes to match, capitalizing on fleeting opportunities. Investors, in contrast, are the strategists, poring over maps and charts, plotting a course for treasures untold. Diversification strategies. Diversification in trading is like wielding a Swiss Army knife, versatile yet compact. In investing, it's akin to assembling a dream team of assets, each playing its part in securing victory over time. Impact of market trends. Traders surf the waves of market trends with the dexterity of seasoned surfers, while investors are like ship captains, steering through storms and calm seas alike, unwavering in their journey. Technology's role. In trading, technology is the jet fuel propelling rockets through a landscape of opportunities. In investing, it's the compass and sextant, age-old tools evolving for the modern navigator, guiding the way through an ocean of assets. Community and social aspects. For traders, the community is like a stock exchange's trading floor, buzzing, volatile, and information-rich. For investors, it's more like a book club, where insights and wisdom are shared over time, cultivating richer understanding. Thank you for joining us on this enlightening journey through the differences between trading and investing. Whether you're an aspiring trader or investor, remember to conduct thorough research, be mindful of the risks, and perhaps most importantly, stay true to your financial goals. Till next time, may your financial endeavors be fruitful and rewarding.